So here's the problem. Years ago, life insurance professionals would receive in-depth sales training, not only showing different life insurance products and how they work, but the advanced planning concepts that bring in the 5, 6, and 7-figure commission checks. Fast forward to today, and those types of training programs are almost non-existent. To solve the problem of inefficient marketing efforts and advisors stumbling around trying to understand how to do business in the advanced markets, Trained Advisor leads the way in showing top-level producers how to acquire, identify, present, and close advanced life insurance cases. Welcome to the weekly 10-minute concept training with Trained Advisor.
Okay, in this module, I really want to talk about really the guts of the buy-sell agreement. Talk about, really, what does a buy-sell agreement do? Because I think there's a lot of misunderstanding out there from both the advisor standpoint and the client standpoint. I just want to make sure we get us all on the same page so that as we're helping our clients, so that we know that we're working through the right issues. And if you look at a buy-sell agreement, what we are going to do is really pre-plan the exit. So we're going to try and look with crystal ball into the future and say, what is it that we're trying to do with this business? How do we need to protect the business? You'll hear me say this here and in other places. If we protect the business, everybody wins. What do I mean by that? Well, if we protect the business wins, and all of the employees win, and all of the owners of the business win, and their families can win. So if you think about it, worst case scenario, let's take two partners and they don't plan. And they don't plan for the future exit of one of the partners. And I've seen this happen, and this is some case that I had way back in the early part of my career. Two business owners, they owned a pharmacist business. And these two families vacationed together. They did everything together. Really were more like family than friends. And they go along, all of a sudden one of the partners died. And when that partner died, that's when they realized they didn't have anything in place. Well, they go through, they have the funeral. After the funeral, the deceased partner's kids show up and say, okay, we're ready to get Dad's $1 million from the business. And the surviving partner said, well, what $1 million? And they said, well, Dad always said my business is worth $1 million. We're here to collect. Well, needless to say, 3 law firms later, they're no longer friends, and the buyout was about $300,000. And what happened? Well, they failed to pre-plan what was going to happen. And so the first thing you have to look at in any buy-sell agreement, what's the trigger? Or triggers, I should say. What is it that's going to make this buyout happen? Well, the easy ones are death, disability, let's just say transfer of ownership. Now, transfer of ownership can be voluntary. It can also be involuntary. What do I mean by involuntary? Let's say if one of the partners has a bankruptcy or they get divorced and spouse owns the business. Why is that a problem? Let's say I have a business and my partner and I are doing great, but my partner gets divorced. And now whatever happens in the divorce proceedings, his spouse gets his 50% ownership in our business. Well, when my partner and I were working, I did 50% of the work. He did 50% of the work. Now, his ex-spouse owns half the business, but our type of business, isn't providing any work into that business. Now, I'm expected to carry 100% of the load of the business, but I only get 50% of the profit. So we want to protect against that. And if you start looking, we have both voluntary and involuntary triggers. This voluntary trigger, what if I just get to the point where I want to leave the business? I want to retire. Doesn't have to be a retirement. It can be I'm just tired and want to move on with a different part of my life, or I'm moving. Whatever it is, that voluntary one, I'm leaving and I don't want to leave my partner high and dry, or my partners, or one of them leaves and I don't want to be left, with the responsibility of 100% of the business, but only getting 50% or less of the profit. So you start coming through these triggers, and we want to start looking at the future exit of this business. Someone's going to die, become disabled, leave. If we've got professionals, we've got to worry about a professional license. If I'm a licensed attorney and I lose my license, I can no longer provide service to the partnership. So you start coming through those triggers, and there's no mandatory list of triggers, but you start looking at what do those triggers, and it really becomes one where either my partner is left, voluntary or involuntary, the ownership has transferred, voluntary or involuntary. And now what do we want to have happen? And so you start looking at the triggers. That's a key. And we want to make sure we spend time with our clients making sure that those triggers are identified the right way. Then we want to come into type of buy-sell, and I'll give the list now, but I'll hit definitions more in another module. But we can have a cross purchase. We can have a redemption, or we're going to have a hybrid. Hybrid is a combination of cross purchase and redemption. Once we identify triggers, type of buy sell, now we always come over to the funding. Now, this is one of those areas that is kind of pet peeve for me. Somebody goes and asks asks a prospect, and do you have a buy sell agreement? Sure. Whether they do or not, who knows? But then they say, have you funded your buy sell? And I think we're really doing a disservice at that point, because what does that even mean? I funded my buy sell. Well, what we're really asking is, if one of these triggers happens, we've got the written agreement in place, how are we going to, quote, pay for it? That's what we're really asking the client. If this happens, are you in a position to write the check? And this is where it really comes into, life insurance will play a significant role in all of our buy-sell planning, because life insurance can come back and check off so many of these boxes on the triggers. If you think about life insurance, what can it do? Number one, it can give us a death benefit. Think about this. You've got a successful business, and your successful business relies on partner A and partner B taking 50% of the load each. And since they're taking 50% of the load each, they really work well together, the business is successful, partner B dies. Well, partner B dies. Partner A has to buy him out according to one of these agreements. Well, if we have life insurance on partner B, partner A now gets a tax-free death benefit and can go pay off partner B's family. It hasn't upset the cash flow of the business. And we do know that at that point in time, it's partner A's got to figure out how the business is going to continue, and hopefully they've addressed it from a key man standpoint if that's the case. But at least partner A doesn't have to reach into their checkbook, their bank account, and fund that buyout out of current cash flow. Now, what happens in a lot of cases is there was no pre-planning and partner B dies, and so instead of having a death benefit, they have to come down here and pay off over time. Now, we may pay a portion with the death benefit and pay the rest over time on an installment note, but I think a lot of people fail to plan, and that's the default. And so failure to plan is going to cost more money. The other thing life insurance can do now with our long-term care and chronic illness riders is it can provide cash flow. We can accelerate a death benefit in the event of disability. So I've worked on cases where we've had, partner B, instead of dying, partner B got dementia. And now if you want to talk about a tough situation, well, if we didn't have that trigger built into here, now partner B's family just keeps taking those paychecks that keep coming in because we didn't have a written buy-sell and didn't trigger disability. They've got to pay for assisted living, home health care, those types of things. If they're not obligated to sell, they may not sell. But if we put disability in as a trigger, now we have those long-term care and chronic illness riders where we can accelerate that death benefit, and instead of just using the cash value to buy them out, now we can actually accelerate the death benefit and use that as part of our buyout. The third thing that life insurance can bring into it is cash value. If we've got a cash value policy, what's nice in that situation is we can reach in tax-free, take out some of that money to help fund that so our installment payments are lower or non-existent. So life insurance really can create a great opportunity in the buy-sell agreement. But before we get there, we've got to address the triggers, the type of buy-sell. This is just the last piece of how do we help you pay for it. And what I think life insurance brings is the word leverage. It helps us leverage the eventual payment, so we're not stuck with paying it over time. And we'll address more of this in the other modules with some examples.
Hey, that was some pretty good stuff, right? Do you want to take a deeper dive into how we're leveraging social media to increase the efficiency of marketing efforts for life insurance advisors? We've been working hard behind the scenes to put together a training that gives a closer look at both the tools and strategies we're using every single day. Go to linktoelite.com and get registered so you can be the first to know once that training goes live. Again, that's linked2elite.com.